Hi friends, in this video we are going to discussing about mock test for module 1 in NISM 10A Investment Advisor Level 1. First question, which of the following best describes a client's ability to take risk? Option A, their willingness to accept loss. Option B, their age only. Option C, their financial capacity and time horizon. And option D, their recent investment performance. Correct answer is option C. Risk ability is based on the tangible factors like income, wealth and time to goal. Next question. A person wants 20 lakh after 8 years at 9% interest. What is the amount they need to invest now? Option A 10 lakh 50,000. Option B 9 lakh 60,000. Option C 10 lakh 6,000. And option D 9 lakh 98,000. Correct answer is option C 10 lakh 6,000. Present value formula is future value divided by 1 plus r whole to the power of n. Let's substitute all the values in the formula. So here PV equal to future value is 20 lakh divided by 1 plus r is 9%. So 9 by 100 whole to the power of 8 equal to 10 lakh 3,733. So the nearest option is 10 lakh 6,000. Next question. Which of the following is not part of the 6-step financial planning process? Option A, gathering client data. Option B, implementing recommendations. Option C, filing tax returns. And option D, monitoring the plan. Correct answer is option C, filing tax returns. Tax filing is not a financial planning step, though related to personal finance. Next question. Present value of 1,10,000 after 2 years at 4% discount rate is option A 1 lakh, option B 1,06,300, option C 1,01,920 and option D 98,000. Correct answer is option C 1,01,920. PV formula equal to future value divided by 1 plus r whole to the power of n. So substitute all the values, then we will get 1,01,699. So the closest value is option C. Next question. Which of the following is a qualitative factor in goal-based planning? Option A, retirement corpus value. Option B, housing down payment. Option C, risk appetite. And option D, SIP amount. Correct answer is option C. Risk appetite reflects the attitude and tolerance, not numbers. Next question. Which of the following is true of SIPs? Option A. SIP gives fixed returns. Option B. It avoids market risk. Option C. It averages cost over time. And option D. It gives tax exemption. Correct answer is option C. SIP benefits from the rupee cost averaging. Next question. What is the purpose of creating a personal cash flow statement? Option A, to file taxes. Option B, to identify discretionary income. Option C, to compare assets. And option D, to measure investment performance. Correct answer is option B, to identify discretionary income. Cash flow statement helps identify surplus or discretionary income and adjust spending. Next question. Which of the following budgeting methods gives the most discipline? Option A, line item budgeting. Option B, mental budgeting. Option C, backward budgeting. And option D, thumb rule budgeting. Correct answer is option A, line item budgeting. This method tracks and justifies each expense category. Next question. Present value of 10,000 for 3 years at 5% is option A 27,234, option B 28,000, option C 25,000 and option D 29,500. Correct answer is option A 27,234. Here is the explanation for the problem. PV equal to PMT means periodic payment into 1 minus 1 plus R whole to the power of minus n divided by R. So substitute all the values, then we will get the answer 27,232. Next question. Which of the following expense is least flexible during financial distress? Option A, loan EMI. Option B, entertainment. Option C, dining out. And option D, travel. Correct answer is option A, loan EMI. It is contractually fixed. So, missed payments lead to the penalties. Next question. A client earns 1 lakh per month, spends 70,000, including EMI 20,000. What is their surplus and savings ratio? Option A, 30,000 and 30%. Option B, 20,000 and 20%. Option C, 10,000 and 10%. And option D, 15,000 and 15%. Correct answer is option A, 30,000 and 30%. Here, surplus formula is the income minus total expenses. So, income 1 lakh minus total expenses including EMI is 70,000. So, 30,000 is the surplus. Now, savings ratio. Savings ratio formula is 30,000. That is surplus divided by income equal to 30%. Next question. What is the effective annual rate for a 12% nominal rate compounded monthly? Option A, 12%. Option B, 12.36%. Option C, 12.68%. And option D, 13%. Correct answer is effective annual rate formula equal to 1 plus R by N whole to the power of N minus 1. So substitute all the values. That is 1 plus R means 12%. So 12 divided by 100 equal to 0.12. N means here compounded monthly. So for monthly we have to take 12. If it is half yearly 6. Like this we have to take. So divided by 12 whole to the power of n means again 12 minus 1. So total equal to 0.1268. If we translate into percentage then it will become 12.68 percentage. What happens to the PV of a future amount if the discount rate increases? Option A, PV increases. Option B, decreases. Option C, stays the same. And option D, FB decreases. Correct answer is option B, present value decreases. Higher discount rate reduces the present value. Next question. Client wants to receive 1 lakh every year for 5 years. Then what is the present value at 10%? Option A, 4,50,000. Option B, 3,79,000. Option C, 4,21,000. And option D, 3,79,078 rupees. Correct answer is option D. The formula equal to PMT into 1 minus 1 plus R whole to the power of minus n by R. Substitute all the values, then we will get the answer 3,79,078 rupees. Next question. Which of the following is a discretionary expense? Option A, loan EMI. Option B, utility bill. Option C, grocery. And option D, vacation. Correct answer is option D, vacation. Discretionary is equal to non-essential and lifestyle related. Next question. If EMI is 18,000 and income is 60,000, then what is the EMI to income ratio? Option A, 30%. Option B, 33%. Option C, 36%. And option D, 25%. Correct answer is option A, 30%. Formula is EMI divided by income into 100. So EMI is 18,000 divided by income 60,000 equal to 30%. Next question. Which of the following component of EMI reduces over loan tenure in a fixed EMI structure? Option A, EMI amount. Option B, principal. Option C, interest. And option D, tenure. Correct answer is option C. Interest declines while principal portion increases. Next question. A borrower takes 40 lakh loan at 8% for 15 years. How much interest will they pay if EMI is 38,214? Correct answer is option B. Total interest they should pay 29 lakh 17,520. First calculate the total amount, that is total months is 15 years into 12 months per year is equal to total 180 months. So EMI into number of months is 38,214 into 180 is 68 lakh 78,520. So now they took the loan is 40 lakh. So total amount paid minus loan amount is equal to 28 lakh 78,520 is the interest they should pay. Next question. A financial plan review is ideally done option A monthly, option B quarterly, option C annually or on major life change, and option D only after retirement. Correct answer is option C annually. Plans must be reviewed regularly and get significant life or market events. Next question. What is the present value of 50,000 to be received after 5 years at 6%? Correct answer is option C 37,360. Formula is present value equal to future value divided by 1 plus r whole to the power of n. Now substitute all the values in the formula. Now we will get 37,360 is the answer. Next question. Which of the following metric best assess short-term liquidity? Option A net worth, option B emergency fund ratio, option C return on capital, and option D debt to income ratio. Correct answer is option B emergency fund ratio. Emergency fund equal to liquid assets divided by monthly expenses. Next question. Which of the following is an example of good debt? Option A personal loan for vacation, option B home loan, option C loan against shares, and option D overdraft used for shopping. Correct answer is option B home loan. Next question. Client wants 15 lakh in 7 years. What SIP amount is required if return is 12% per annum compounded monthly? Correct answer is option B 12,300. Next question. Which of these factors does not affect loan EMI? Option A interest rate, option B tenure, option C credit score, and option D loan amount. Correct answer is option C credit score. It affects loan approval and interest rate, not EMI directly. Next question. Which of the following best represents real return? Option A nominal return plus inflation, option B nominal return minus tax, option C nominal return minus inflation, and option D absolute return into risk. Correct answer is option C nominal return minus inflation. Next question. Client needs 1 crore after 15 years. What lump sum investment is required today at 10% per annum return? Correct answer is option C 23 lakh 94,000. Present value equal to FP divided by 1 plus R whole to the power of n. FP is 1 crore divided by 1.10 whole to the power of 15. Next question. A loan of 20 lakh is taken at 9% for 10 years. Approximate EMI is option A 25,000, option B 27,000, option C 25,335, and option D 28,200. Correct answer is option C 25,335. Here is the EMI formula. Let's substitute all the values. Next question. Which of the following affects both PV and FV calculation? Option A, risk appetite. Option B, inflation rate. Option C, discount or interest rate. And option D, client's income. Correct answer is option C, discount or interest rate. The rate is directly affects time value calculations. Next question. Client has 15 lakh in assets and 21 lakh in liabilities. The net worth is option A 6 lakh, option B 36 lakh, option C minus 6 lakh and option D 0. Correct answer is option C minus 6 lakh. Net worth formula is assets minus liabilities. Here liabilities are more. So it is 15 lakh minus 21 lakh is minus 6 lakh. Which of the following is an appropriate planning product for a 10 years goal with good interest rate? Option A equity mutual fund, option B long term bond, option C liquid fund and option D T-bills. Correct answer is option A equity mutual fund. Next question. Which of the following is best for a client with low risk tolerance and short term goals? Option A PPF, option B equity, option C liquid fund and option D gold ETF. Correct answer is option C. Liquid funds are low risk and ideal for short term needs. Next question. Which expense would be considered non-discretionary? Option A dining out, option B mobile recharge, option C grocery and option D vacation. Correct answer is option C. Groceries are essential to daily life and are non-discretionary. Next question. Which of the following budgeting method starts from zero and justifies every rupee? Option A envelope budgeting, option B zero based budgeting, option C backward budgeting and option D rule based budgeting. Correct answer is option B. Zero based budgeting gives maximum control. Next question. What is the present value of 25,000 per year for 4 years at 8% discount rate? Correct answer is option D 82,803. Next question. If EMI is reduced by extending tenure, what happens to interest burden? Option A decreases, option B increases, option C unchanged and option D eliminated. Correct answer is option B increases. Lower EMI equal to longer term, then more total interest should be paid. Next question. Which of the following ratio helps measure reliance on borrowing? Option A liquidity ratio, option B emergency fund ratio, option C debt to income ratio and option D savings ratio. Correct answer is option C debt to income ratio. Its formula is EMI divided by gross income. Next question. APR annual percentage rate includes option A only interest, option B only fees, option C interest plus fees and option D insurance cost. Correct answer is option C interest plus fees. APR shows full cost of credit over a year. Next question. Client invests 10,000 monthly for 15 years at 11% return. Then what is the future value? Option A 34 lakh, option B 40.4 lakh, option C 41 lakh and option D 44 lakh. Correct answer is option D 44 lakh. Please check here explanation. Here 180 means we are calculating here monthly. So we need to convert years into monthly. So 15 into 12 months equal to 180 months. R is 11%. So again monthly. So divided by 12. 0.11 divided by 12. So calculate all these values. We will get 44 lakh 18,700. Next question. Client earns 80,000 per month. EMI is 30,000. Is it healthy? Correct answer is option C. Yes. Debt to income ratio is 40%. So here 37.5% is the DTI. So which is acceptable. It should not cross 40%. Next question. Which of the following Excel function computes PV of future payments? Option A equal to FE, option B equal to NPV, option C equal to PV, and option D equal to IRR. These are all options are in the formula of Excel. Correct answer is option C equal to PV. Next question. Which of the following action helps reduce loan tenure? Option A skipping EMI, option B increasing EMI, option C reducing EMI, and option D taking top up loan. Correct answer is option B increasing EMI. If increase the EMI, then reduces the outstanding faster. So shorter tenure. Next question. Which of the following is least appropriate for emergency funds? Option A savings account, option B liquid fund, option C gold ETF, and option D FD with premature withdrawal. Correct answer is option C gold ETF. Those are volatile and less liquid for emergencies. Next question. If interest rate rises, what happens to PV of a fixed future amount? Option A increases, option B unchanged, option C decreases, and option D doubles. Correct answer is option C decreases. Next question. A 1 lakh loan at 12% for 1 year with monthly interest only EMI. What is the EMI? Option A 10,000, option B 12,000, option C 1,000, and option D 2,000. Correct answer is option C 1,000. Monthly interest equal to 1 lakh into 12% is the interest rate. So divided by 12 months. So equal to 1,000 rupees. Next question. Which budgeting approach allocates income as percentage to needs, wants and savings? Option A envelope, option B balanced, option C zero based, and option D 50-30-20. Correct answer is option D. 50% is needs, 30% is for wants, and 20% is for savings. Thank you for watching my video. Please subscribe for more videos.